Welcome to our monthly view from the Edge for May 2021. I'm Fritz, the Chief Investment Strategist here at 3Edge, and with me here today, as he is each month, Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. As we do at the beginning of each month, Eric and I will provide a brief update on this week's activity in the global capital markets, and then we'll discuss our most recent outlook, which is based on a proprietary research model. We'll stick with our new format, and which we adopted last month, and we'll focus on those asset classes where either there's been a change in our outlook from April to May, or any other asset class that we feel it would make sense to mention today in a bit more detail. And as a reminder, the full print version of our monthly View from the Edge newsletter is available on our website, 3edgeam.com. So let's get started and have a brief recap of the markets this week. And stocks declined at the beginning of the week, but then rebounded. Data continues to show the U.S. economy bouncing back as the country emerges from the coronavirus pandemic. U.S. GDP growth at an annualized rate of 6.4% in the first quarter of 2021. And positive news so far this week was enough to overcome investors' recent fears over the potential for rising inflationary pressure. There's also more good news on the jobs front as the labor market continues to improve with the U.S. economy reopening more broadly. However, even with the employment picture in the U.S. improving, there are still approximately 10 million Americans who are officially counted as unemployed. So where we go from here, equities continue to hover around all-time highs, while investors weigh the implications of a robust economic rebound and improving employment picture against concerns about future inflation and whether the current increases in inflation will be transitory, as Fed Chair Powell and the Federal Reserve insist, or could inflationary pressures prove to be more sticky and longer lasting. For now, it appears investors are taking Powell and the Fed at their word. However, should investors become convinced that inflation is going to be a longer lasting and going to be potentially problematic, i.e., if there's a change in investors' expectations for future inflation, they could then force the Fed to take action, and they may be forced to begin to taper their ultra-easy monetary policy sooner than anticipated. And should inflationary expectations take hold, real assets such as commodities and gold could benefit. So now let's get to our most recent model research outlook and our view from the Edge for May, and let's bring Eric into the conversation here. And maybe, Eric, you could take us through our dot plot chart for May 2021 to get us started.
Sure, thanks, Fritz. That was a great recap of the week here and the month. When you take a look at this chart here, it quite frankly just doesn't look like there's a lot of change going on in the model with only a few of those dots moving. But today, there is actually some stuff going on under the hood that we wanted to highlight. So in particular, we're going to really focus on U.S. and emerging market equities, as well as real assets, including both gold and commodities.
Excellent. So I know we're kind of tired of saying that equities are overvalued, but our model research does still tell us that that is the case. But our model research also indicates that for now, the Fed may be able to keep the U.S. The U.S. equity markets moving higher. So maybe you could take us into a bit of a deeper dive on the U.S. equity market.
Yeah, as you noted, the U.S. equities do continue to reach all-time records, new highs. And as you've also noted, and as we've said for many months now, U.S. equities, by our measure, continue to be incredibly overvalued relative to almost any other point in history. That being said, that's just valuation, one of the three edges that we look at. Things like high yield spreads continuing to tighten, if you can believe it, very positive contributor to the outlook there. And as we've noted, the incredible central bank stimulus from the Fed that we've seen continues to be a positive driver in the measures of the yield curve that we have. We touched on the shadow rate concept last week in that weekend video. But it's important to note what we're seeing from the model. We're picking up some tea leaves that the possible regime shift may be underway. And that's evidence from the shift from monetary to fiscal spending. And this perhaps could be a catalyst for consumer price inflation to increase that you just noted, and away from the asset price inflation that we've seen through central bank measures alone. So in this scenario, should it manifest and play out, we could see a rotation out of large cap growth and tech stocks with a shift towards companies that are really more tied to the real economy, cyclical type stocks like value equities.
Excellent. Very good. Very excellent description of how we may be seeing this regime change take shape. So I think the other asset class in terms of equities that we could look at would be the emerging markets, where it seems that investor psychology has started to soften somewhat. What else are we seeing in the EM equity markets?
Yeah, so emerging market equities, by our measure, are also overvalued, which is it's been flirting with the fair value and overvaluation levels, but more firmly in the overvalued level now. Positive economics. We are seeing steepening yield curve measures both in the emerging markets, China and India, but also benefiting from the steepening measure here in the US as well. Tightening credit spreads, another positive. These are good things. But as you noted, investor psychology measures that we look at have softened somewhat, and it clouds the short-term outlook with the heightened chance of increased volatility shorter term. Emerging market countries like China, and India, they may benefit from the fiscal stimulus that we just passed here in the U.S. Given the degree to which the U.S. imports from these other emerging market countries. So still overall positive on it, but maybe a little less so than just a month ago.
Very good. So now we're going to shift all the way down into the real asset world and talk about commodities and gold. And I guess what I mentioned in terms of market outlook and this idea of the Fed saying that inflationary pressure is, clearly transitory. Well, if that's not the case and we get more inflation, it lasts longer, that certainly could have an impact on real assets, right?
Yeah, absolutely. That could definitely be a positive. And as you noted, it really puts the Fed in that proverbial in between a rock and a hard place if they really have to act to stave off any real true inflation that manifests, given that they've been pretty public about not making any moves until the end of 2023, early 2024. In terms of gold, what we're seeing, we have noted a month ago even gold struggled in the first quarter of this year. We noted that it hit a key behavioral inflection point towards the end of that first quarter, whereby the risk of a further decline was high. And because of that, we had a modest reduction in our outlook from that. Since then, though, and a large part of that was we picked up from looking at real yields, and real yields have been quite negative. They started the year around minus 110 basis points, or minus 1.1%. That is the nominal less inflation measure. And they backed up to about minus 60 basis points, which is a negative for gold towards the end of the first quarter. Now we've just seen they've just ticked right back down to about minus 90 basis points, which has been a positive for gold. We've seen gold now increase, and it's increased the conviction of the model's outlook on gold. So positive increasing prospects from rising inflation, as you noted, even in part from the passing of the recent fiscal program, also another positive for gold. Shifting to commodities. Commodities remain relatively undervalued from our measure. Commodities have already performed well over the last year, but in the grand scheme of other commodity super cycles that we might look at, this is just the tip of the iceberg. This is just the beginning, and should this recovery continue, there's a lot of room to run in terms of commodities. The model is showing signs of strength from the appreciation in the Chinese yuan. Tightening credit spreads, we've noted that that's a positive for the equity markets as well. Steepening yield curve measures that we look at, and positive investor psychology measures as well. So commodities are really firing on quite a few cylinders here. Now we saw some recent dollar strength in Q1, which was a headwind. Though that being said, in just the past month, we've seen that weaken back down. So once we develop a stronger trend on a weaker dollar, that too would be more conviction for stronger support for commodities and real assets more broadly.
Excellent, great. So we've seen some minor changes in a few of the equity asset classes. We're seeing some minor changes in real assets, but otherwise the model is still fairly stable, and it's still keeping us in the equity markets writ large. So great. Well, thank you very much for that recap. Eric and I will be back once again in early June with our next edition of our View from the Edge. And meanwhile, Steve Cucchiaro and I will be back at the end of next week with the latest edition of the 3 Edge Week in Review. As a reminder, all of our videos are available on our YouTube channel and on our website at 3edgeam.com. Also, please feel free to share any of the videos if you think someone you know may be interested. And so now, on behalf of everyone here at 3 Edge, we urge you to remain safe, to stay strong, keep the faith, And most of all, thanks for listening. And thanks, Eric.
Thank you.